Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at on holding.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just before we really jump into the meat of it today, make sure to check out the special 14-day trial link for StockOracle down below in the description.
Yeah, highly recommend checking that out.
Right. And just to be totally transparent, that is an affiliate link, so the channel may earn a commission at no extra cost to you. But we have to mention, StockOracle is an AI-aided stock research platform. It is not financial advice, it's not a trading signal service, and it's not real-time market data.
Exactly. It's a tool, not a crystal ball.
Right. The AI insights and valuation estimates can be incomplete or, just wrong. So always verify important facts on your own. But with that out of the way, I want you to picture something. Imagine you walk into your boss's office, right?
Okay, I'm picturing it.
You drop this massive report on their desk. You show them that you just hit absolute record profit margins, you tripled the company's cash reserves, and you built the most premium brand in your entire industry.
Sounds like a pretty good day at work.
Right. You're expecting a huge bonus. But instead, your boss looks at the report and immediately docks your pay by 19%.
Oh, wow. Yeah, that's rough.
It's insane. But that is exactly what Wall Street just did to On Holding.
It completely defies standard business logic, honestly.
It really does. So today, we are unpacking the immediate fallout from On Holding's Q2 2026 earnings. It is, frankly, a masterclass in this massive friction between long-term brand equity and the relentless short-term demands of algorithmic trading.
Yeah, and if you follow the athletic footwear market, you definitely know On Holding. They're the brand behind those hollowed-out cloud-like soles you see everywhere right now.
Oh, yeah, the ONON ticker. They are everywhere. But we really need to dissect this paradox. How does a company post genuinely phenomenal fundamental numbers only to watch its valuation just, basically fall off a cliff in a matter of days?
It's wild because, looking at the surface data, they should absolutely be taking a victory lap right now.
Exactly. So let's look at those Q2 fundamentals because they are incredibly robust.
They really are. So net sales hit 850 million Swiss francs.
Which is huge.
Right. It represents a 21.6% growth rate in constant currency, and their trailing 12-month revenue growth is sitting at 18.48%.
Okay, so top-line revenue is growing by double digits.
Yeah.
What about liquidity?
Oh, from a liquidity standpoint, the balance sheet is just pristine. They have grown their cash reserves from 184.6 million at the close of 2022 to a massive 629.3 million today.
So they are incredibly well capitalized. They're sitting on a mountain of cash. But there's one number here that really stops you in your tracks, and that's the gross margin.
Oh, the gross margin is the star of the show. They hit a record 65.4%.
65.4%?
Yeah.
Achieving a 65% gross margin on a physical manufactured product is borderline unheard of in the apparel space.
It really is. It indicates supreme pricing power. People are paying top dollar. But to understand how they're actually pulling that off, we have to look at the mechanics of their sales channels. Because On Holding is executing this highly disciplined reduction in their wholesale sell-in.
Okay, let's break down the mechanics of that, because I feel like this is the core of the entire controversy.
It absolutely is.
So wholesale sell-in basically means they are actively choosing to ship fewer boxes of shoes to third-party sporting goods stores, which is crazy because typically that wholesale channel is just easy revenue.
Yeah.
You back a truck up to a major retailer, you offload 10,000 pairs, and you book the revenue immediately.
Right. But you're selling those shoes at a massive discount so the retailer can mark them up and make their own profit.
Exactly.
Yeah.
And you also lose control of the environment. Yeah. Like, if your premium running shoe is sitting on a metal rack next to some heavily discounted mid-tier competitor shoe,
your brand equity just bleeds out.
Right. So by pulling back from wholesale, On Holding is basically forcing the consumer into their direct-to-consumer channel, the DTC channel.
Yeah, they want you buying on their app, on their own website, or walking into their own flagship stores.
Because in that DTC model, they capture the entire retail markup. They don't have to split a single dime with a middleman.
They keep the full margin, yeah. But more crucially, they maintain absolute control over the pricing. The product is never, ever put on a clearance rack just to clear out a third-party retailer's aging inventory.
Hey.
They are fiercely protecting what they call their full price integrity.
I love that phrase, full price integrity. It's almost like On Holding is a trendy nightclub, right? And they are deliberately tightening the velvet rope.
That's a great analogy.
They're letting fewer people in through the side door, which is the wholesale partners,
Mhm.
because they want everyone lining up at the front door paying the absolute full cover charge. They are artificially restricting supply in certain channels to mandate exclusivity.
And that velvet rope strategy is incredibly effective for margin expansion, but it comes with a pretty severe near-term cost.
Okay, we go. The catch.
Yeah, here's the catch. Because they aggressively pulled back on that wholesale inventory, On Holding had to guide their full year 2026 sales to the lower end of market expectations. The DTC channel is booming, sure, but it simply cannot instantly replace the massive volume of those bulk wholesale orders they are voluntarily walking away from.
But wait, if their margins are this good and the brand is this strong, what is Wall Street seeing that we aren't? I mean, are they assuming the consumer just going to stop buying premium shoes altogether? Why punish a company for making a move that clearly strengthens the business in the long term?
Because institutional investors operate on a deeply entrenched quarterly cadence. They are obsessed with the next 3 months. So when a management team announces, hey, we're going to accept lower overall revenue today to build a stronger margin profile 5 years from now.
The algorithms freak out.
Exactly. Algorithmic trading models do not care about a 5-year vision. They immediately reprice the stock based solely on that downward revision in near-term cash flow.
Which triggers a massive technical breakdown.
Yeah.
Because On Holding chose brand integrity over maximum short-term sales volume, the market's reaction was just swift and brutal.
Very brutal.
Looking at the charts, the stock's last price is sitting at $32.22. That is a 37% collapse from its 52-week high of $51.08.
The technical damage is severe. I mean, the stock has decisively fallen below its 20-day, 50-day, and 200-day simple moving averages all at the same time.
Yeah, and when you see a stock slice through its short, medium, and long-term moving averages all at once, that isn't just a minor correction.
No, not at all.
That is a flashing red signal that institutional momentum is completely broken.
The selling pressure was relentless. I mean, just the 5-day return alone logged a negative 16.9%.
Wow.
Which perfectly isolates the market's visceral reaction to that Q2 earnings release and the subsequent guidance disappointment.
Yeah, and if you're analyzing this setup, you really have to appreciate the irony in how the major financial institutions are covering this drop. The analyst sentiment right now is just wildly contradictory.
Oh, it's all over the place.
Right. On one hand, Raymond James came out and flat out downgraded the stock, which, makes logical sense if you believe the momentum is broken.
Yeah.
But then you look at what UBS is doing.
Yeah, so UBS actually maintained their buy rating, but they cut their price target from $83 down to $73.
But even at 73, they're projecting more than a 100% upside from the current $32 price.
Exactly.
And UBS isn't alone. You look down the list of heavy hitters here. Telsey, Stifel, Truist, Evercore, Barclays. Every single one of these firms slashed their price targets for On Holding. Yet at the exact same time, they all maintained buy or outperform ratings.
It sounds totally contradictory, but to understand that disconnect, you really have to look at how analysts construct discounted cash flow, or DCF, models.
Okay, yeah. Explain that for us.
So these DCF models are highly sensitive to near-term inputs because On Holding lowered their 2026 revenue guidance by restricting wholesale. Analysts have to plug lower revenue numbers into the next 12 months of their spreadsheets.
Right.
And that mathematical adjustment automatically spits out a lower 12-month price target.
So they dropped the target from 83 to 73 simply because the math for this current year basically demands it.
Exactly. The near-term math changes. But the back end of those DCF models, the terminal value covering the next 5 to 10 years, that is heavily weighted toward profit margins.
Always.
And because On Holding just proved they can sustain a 65% gross margin by leaning into DTC, the terminal value of the company actually looks stronger than ever.
That is fascinating.
Right. The analysts are slashing the price target because they literally have to acknowledge the near-term revenue deceleration. But they are maintaining the buy rating because the 5-year profitability thesis is practically a gold mine.
So it's like Wall Street desperately wants the destination, but they are absolutely terrified of the journey to get there.
That is it exactly. They hate the transition period. That 19% drop post-earnings is just a textbook institutional reaction to transition risk.
Yeah, so if you're holding any on right now, or maybe you're considering jumping in at $32, the natural question is whether the worst is over.
Right.
Catching a falling asset after a 37% haircut from its highs requires really understanding if this is just a temporary repricing event
Hmm.
or a deeper structural failure.
And evaluating that requires looking at the stock's inherent volatility, specifically its beta. On holding currently has a beta of 2.09.
Wow. Okay, for anyone listening who isn't familiar, a beta over 2 is basically like driving a Ferrari in the snow.
That is the perfect way to describe it.
Right. The steering is hyper-responsive. If the broader market just twitches, this stock slides twice as far in either direction.
Exactly. That high beta, combined with a trailing price-to-earnings ratio of 21.31, creates this classic high-growth, high-wire act.
Yeah.
When a stock is priced for perfection, any strategic pivot that lowers near-term guidance isn't just a bump in the road, it is a structural reset of expectation.
Which means high beta stocks are aggressively rewarded when the narrative is flawless and just ruthlessly punished, the moment management asks for a little patience.
Absolutely.
Yeah.
Which brings us to the core bear case right now. The broader athletic footwear market is currently drowning in heavy promotional pressures.
And that is just the polite corporate way of saying the entire industry is locked in a desperate discount war because the consumer is tapped out and totally tired of paying full price.
Yes, exactly. If you look at the major legacy brands, they are flooding the market with 20, 30, and 40% off sales just to clear aging inventory and hit their quarterly volume targets.
And this is where the execution risk honestly terrifies me a bit. If the giants of the industry are aggressively discounting their shoes just to survive, and On Holding is stubbornly holding the line,
Tightening that velvet rope.
right, demanding absolute full price, aren't they basically daring the consumer to just walk away? Because, you can't eat brand equity. If the consumer simply refuses to pay full price and sales drop, the stock is going to continue to plummet.
That's a valid fear, but you can absolutely starve from margin erosion.
Fair point.
Discounting destroys brand equity permanently. If we look at legacy retail history, once you train a consumer to wait for a 30% off sale, you never get them to pay full price again.
Oh, totally.
Yeah.
I am completely guilty of that.
Right, we all do it. So the bears argue that On Holding's premier positioning faces a massive test in this discount environment. But the counter-argument is that On Holding absolutely must hold the line.
Because if they cave,
If they cave and join the discount war, they destroy the 65% margin thesis entirely, and the stock goes to zero.
wow, so it is a high-stakes game of chicken with the global consumer.
Mm-hmm.
They are betting that their product is so differentiated and their brand is so desirable that people will pay $160 on shoes even when competitors' shoe is on sale for $80.
It is the ultimate test of brand power. And honestly, if we look at the technical indicators, the market may have already priced in the absolute worst-case scenario.
Really? What are you seeing there?
Well, the stock's relative strength index, or RSI, is currently sitting at 35.44.
And with an RSI sitting down near 35, the momentum oscillators are signaling near exhaustion.
Exactly. Anything under 30 is generally considered officially oversold, so 35 is basically knocking on the door.
So the market has already aggressively priced in the fear of this wholesale reduction and the broader retail promotional environment.
The panic is largely baked into that $32 price tag. The algorithms have already thrown their tantrum over the guidance cut.
Okay, so we have the tension clearly defined here. Management is playing a long-term game of brand protection. Wall Street is throwing a short-term fit over revenue volume, and the stock is hovering near oversold territory.
Right.
So how does this stalemate break? What is the actual catalyst that forces the market to reevaluate this stock?
The timeline is entirely dependent on upcoming corporate catalysts. There is a critical major prove-it moment on the horizon, and that's the confirmed Investor Day scheduled for September 21st and 22nd, 2026 in Zurich.
Okay, so if you're tracking this narrative that Investor Day is the entire ballgame.
Oh, absolutely. Right now, the overall assessment rating for On Holding is just a painfully average neutral 5 out of 10.
Neutral 5 out of 10.
Okay, yeah. To upgrade that neutral rating, management has to stand in front of institutional investors in Zurich and basically execute on 3 distinct deliverables.
Let's hear them.
First, they must prove the 65% gross margin is not a one-off anomaly.
Right.
They have to present hard data showing that the DTC channel can consistently sustain that profitability profile.
Because if that margin slips to, say, 60% or 55%, the entire velvet rope strategy was a catastrophic failure.
Exactly.
They would have alienated their wholesale partners, sacrificed their volume, and still lost their premium profitability.
That is exactly the risk. So that's number one. Second, they need to present hard metrics proving that direct consumer growth is accelerating at a pace capable of completely offsetting the wholesale revenue they intentionally abandoned.
Makes sense.
And third, they must provide a highly credible multi-year roadmap that restores Wall Street's confidence in their top-line expansion.
And if they nail that presentation, sentiment can literally flip overnight. I mean, the analysts who cut their price targets while maintaining a buy rating will suddenly have the justification they need to raise those targets right back up.
Exactly.
But on the flip side, what breaks the thesis entirely? Like, what should someone analyzing this stock be absolutely terrified of?
There are two specific red flags to watch for. First, the Q3 results, which we will see in November.
Okay.
If those numbers reveal that On Holding isn't just sacrificing wholesale volume, but is actively losing market share to competitors in the premium running space,
Then the long-term thesis completely fractures.
yes. And second, you really have to watch insider selling.
But right now, insider selling is basically negligible, right? I think there was just one tiny open market sale recorded recently.
Yeah, it is practically non-existent right now, which shows great executive confidence. But if you suddenly see a spike in insider selling, like if the very executives who engineered this strategy start dumping their own shares ahead of Q3.
Oh, that is the ultimate leading indicator that the velvet rope strategy is failing internally.
Absolutely.
So if you step back and look at the timeline here, this is not a setup for day traders looking for a quick bounce. We are looking at a highly structured 3 to 6 month waiting game,
Very much a waiting game.
pivoting entirely on that September Investor Day and the November Q3 earnings print just to see if the reality of their sales actually matches the ambition of their strategy.
And that requires a level of patience that algorithms and quarterly portfolio managers fundamentally lack.
Which perfectly encapsulates what we're talking about today. We are looking at On Holding, a company armed with a pristine balance sheet, over $600 million in cash, and record-breaking 65% gross margins.
Unbelievable numbers.
And they just absorbed a 19% hit to their market cap simply because they had the audacity to refuse the wholesale volume game.
They absorbed a massive blow today to ensure their pricing power remains untouchable tomorrow.
Which leaves us with a final thought to really mull over. We talked extensively about the promotional environment. You know, the fact that the entire footwear industry is currently sweating, slashing prices, and entering this race to the bottom just to keep their heads above water.
It is a toxic environment for legacy brands right now.
So consider this paradox. Wall Street is punishing On Holding today for making the exact moves that will prevent them from becoming the next heavily discounted legacy mall brand tomorrow.
That's a great point.
When every other footwear company inevitably turns to desperate discounts just to survive the quarter, On Holding's painful short-term stock drop might actually be the exact moment they secured their permanent survival.
Wow.
Because if everyone else is fighting for scraps in the bargain bin, maybe the only place left to stand out is behind that velvet rope.
It is a massive calculated risk, but the financial mechanics of their margin profile suggest it really is the only viable path to true premium status. The data over the next 6 months will show us exactly who blinks first, the consumer or Wall Street.
It is going to be an incredibly tense transition to watch unfold. We're currently sitting at a bullish score of a neutral 5 out of 10, but the long-term view is where the real story is. Remember to check out that 14-day trial link for StockOracle down in the description below. Thank you for joining us today. Keep questioning the numbers behind the headlines, and we will see you next time.